Hello everyone, this is Victor here. Welcome to the Intelligent Investor channel, where you learn about stock investing analysis and personal finance that will help you become a great investor. Recently, Amazon announced that Jeff Bezos, its CEO and founder, will move to the executive chairman position, and Andy Jassy, the head of Amazon Web Services AWS, will become the new CEO of Amazon in Q3 this year. Also, the US 10-year Treasury yield suddenly jumped above 1.6%. This caused many high-tech growth stocks to crash as much as 10% or even more. In this video, I'm going to talk about why I believe Amazon is likely undervalued now and why I believe the stock is worth $4,470 per share or $2.3 trillion in market cap. I will cover these topics in this video. First, Amazon stock performance. Second, Amazon's intrinsic value calculation. Third, Amazon's 3 long-term growth catalysts. Fourth, Amazon's risks and competition. And fifth, what I will be doing going forward. If you like this video, smash the like button, subscribe, and turn on the notification button. I will continue to make many excellent stock investing analysis videos and personal finance videos that will help you become a great investor. Let's start. Amazon has been one of the best performing stocks in the past 5 years and has benefited a lot from the pandemic in 2020 because everyone is working from home more and shopping online much more than before. The pandemic in 2020 has accelerated e-commerce sales in the US and everywhere around the world for at least 5 years ahead. Amazon is one of the companies that benefited the most from the pandemic. So for example, in the past 1 year, the stock increased 55.95%. In the past 3 years, the stock increased 90.04%. And in the past 5 years, the stock increased 443.05%. Obviously, past return does not guarantee future performance. When analyzing stocks and companies, it's very important to be forward-looking and not backward-looking. It's very important to understand Amazon's long-term growth catalysts that will drive Amazon's revenue, net income, and cash flow growth going forward. Before talking about Amazon's long-term growth catalysts, I want to show you why I believe Amazon stock is undervalued now using a modified discounted cash flow DCF model. I made this modified DCF model to estimate Amazon's intrinsic value per share. It's not a traditional DCF model. I want to make this DCF model as simple and practical as possible. Now, a traditional DCF model has many variables such as earnings before interest, taxes, depreciation and amortization, estimated income tax rate, enterprise value, estimated growth rates over 5 years and 10 years, terminal value and discount rates. The more variables and assumptions there are, the less accurate a DCF model will become. So I wanted to make this DCF model as simple and practical as possible. The intrinsic value of a company is simply defined as the discounted present value of future cash. Warren Buffett said this at Terry College of Business at the University of Georgia. He said,
well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is.
This modified DCF model I made has 3 key assumptions and variables. The first assumption is that we are using Amazon's operating cash flow, not the free cash flow, to estimate Amazon's intrinsic value because Amazon is still a growth company. A growth company tends to reinvest a large amount of capital and cash to grow its business internally instead of paying out dividends or buying back shares. I would prefer Amazon to continue investing its capital back into its business, to continue growing its revenue and net profit because it shows the company still has a lot of growth potential. The second assumption is that Amazon's future operating cash flow growth in the next 5 years will be between 15% each year, which is the worst case scenario, and 35% each year, which is the best case scenario. And the third assumption is that we are using a price to cash flow multiple of 15.97 from Morningstar to calculate Amazon's terminal value at the end of year 5. This means we only have 3 variables to estimate Amazon's intrinsic value and not have many variables in a traditional DCF model. The discount rate we are using is the weighted average cost of capital WACC from Finbox.com. This is based on my estimate. Under the worst case scenario, Amazon's operating cash flow will grow at 15% each year for the next 5 years. Then discounting its future cash flow and its terminal value to the present day, its intrinsic value should be around $3,017 per share or 1.54 trillion in market cap. In comparison, at the time of making this video, Amazon is traded at $3,000 per share or 1.51 trillion in market cap. I will give this worst case scenario a 10% probability because I believe Amazon's cash flow growth rate will be higher than 15% each year for the next 5 years. Under the normal case scenario, Amazon's operating cash flow will grow at 25% each year for the next 5 years. Then discounting its future cash flow and its terminal value to the present day, its intrinsic value should be around $4,422 per share or 2.25 trillion in market cap. I am more confident in this normal case scenario, so I will give this an 80% probability. Under the best case scenario, Amazon's operating cash flow will grow at 35% each year for the next 5 years. Then discounting its future cash flow and its terminal value to the present day, its intrinsic value should be around $6,324 per share or 3.22 trillion in market cap. I believe this is a very optimistic case scenario, so I will give this a 10% probability. If we multiply all these 3 case scenarios together by their probabilities and add them together, we can see Amazon's intrinsic value should be around $4,472 per share or 2.28 trillion in market cap. Again, these are only my estimates based on the 3 assumptions and variables I said earlier. Now let's talk about Amazon's long-term growth prospects. If you look at Amazon's latest Q4 2020's earnings report and 2020 annual report, you can see Amazon's business did very well between 2016 and 2020. For example, Amazon's net sales grew at a compound annual growth rate CAGR of 29.8% between 2016 and 2020. Its net income grew at a CAGR of 73.19% between 2016 and 2020. And its diluted earnings per share grew at a CAGR of 70.93% between 2016 and 2020. This is why Amazon stock did very well and increased as much as 443.05% during the same period. Looking ahead, I believe there are 3 catalysts that will drive Amazon's long-term revenue, net income, and cash flow growth. The first catalyst is Amazon's market-dominant e-commerce business in North America and the international market. Amazon is the dominant leader in e-commerce in North America as well as in many other countries. For example, according to eMarketer, Amazon had a 39% e-commerce market share in the US in 2020. Other competitors such as Walmart, eBay, and Target are far behind. For example, Walmart had an e-commerce market share of 5.8%. eBay had 4.9% and Target had 1.7% in the US in 2020. Amazon has benefited a lot from the pandemic that started in 2020. The pandemic has accelerated online e-commerce sales to at least several years ahead of schedule. More consumers are shifting their purchases online using Amazon because of the pandemic and because it's much more convenient, especially if they are Amazon Prime members. In North America, Amazon Prime members can often have the fastest and free same-day, 1-day, or 2-day deliveries, depending on the products and the purchase price. Here's the important part you may want to know. According to Kantar and this market research here, 63% of consumers start their search for a new product on Amazon before they search products on Walmart, eBay, or other sites. Also, according to eMarketer, US e-commerce sales are expected to continue to grow between 2021 and 2024. Even after the pandemic is over, worldwide e-commerce sales are expected to continue to grow between 2021 and 2024. I believe Amazon has a huge economic moat because Amazon has the largest selection of products in North America. Most people choose to buy on Amazon first before using other e-commerce sites, and it's much more convenient and faster for most customers to buy on Amazon. Amazon is essentially a near monopoly in North America. Even after the pandemic is over, more consumers will continue to shop online. This is why I believe Amazon's e-commerce business will continue to grow in both North America and the international markets for many years. Amazon's second growth catalyst is Amazon Web Services, AWS. This is Amazon's most important and most profitable business now. If you look at Amazon's most recent Q4 2020 earnings, you can see AWS had the highest operating income of $3.56 billion and the highest operating margin of 28%. In comparison, Amazon's North America segment had an operating income of $2.946 billion and an operating margin of 3.9%. Amazon's international segment is starting to be profitable, but it has the lowest operating margin of 1%. Looking forward, I believe AWS will continue to be Amazon's most profitable and most important business. This is why Jeff Bezos chose Andy Jassy, the head of AWS, to be Amazon's CEO in Q3 this year. Andy Jassy has done an outstanding job building AWS to be the largest cloud provider in the world, especially in infrastructure as a service and platform as a service. According to Synergy Research Group, AWS market share has been around 33% for 4 straight years, while the entire cloud market is getting bigger each year. For example, according to this article, Gartner has predicted worldwide public cloud spend to grow 18% in 2021, with 70% of organizations using cloud to increase cloud spending in the wake of COVID-19. The only 2 competitors that can compete with Amazon AWS are Microsoft Azure with a growing market share and Google Cloud. Alibaba is becoming the 4th largest cloud provider in the world, beating IBM. You may wonder which companies are AWS biggest customers. According to Digital Dimensions, AWS biggest competitors include Adobe, Airbnb, Disney, Epic Games, McDonald's, NASA, Netflix, Pinterest, and Reddit. This is from the latest Q4 2020 earnings that also show AWS long-term growth. Amazon CFO said the team also announced significant customer momentum with new commitments and migrations from JP Morgan Chase, Thomson Reuters, Malcolm CBS, and Twitter, just to name a few. We continue to see companies meaningfully growing their plans to move to AWS. In Q4, AWS saw continuation of strong usage and revenue growth. AWS added more revenue quarter over quarter and year over year in any quarter in its history, and is now a $51 billion annualized run rate business, supporting millions of active AWS customers. If you look at this 6-year financial chart here, you can see AWS sales and operating profit have been growing steadily. Now, AWS is the primary profit driver for Amazon, and as of now, the cloud market in infrastructure as a service is a triopoly with the 3 largest players: Amazon AWS, Microsoft Azure, and Google Cloud. It's very hard for smaller players to take away their market shares. Personally, I believe AWS will continue to dominate for many years. Companies will continue to move their IT infrastructures to the cloud instead of building their own data centers, servers, and storage, because it costs companies a lot of money upfront to build and maintain their own IT infrastructures. Companies moving to the cloud allow them to save a lot of money because they only pay based on their usage of cloud services. Amazon's third catalyst is its growing number of Prime members. Right now, Amazon has more than 150 million Prime members worldwide. According to eMarketer, US Prime members are expected to grow to 153.1 million by 2022. This article shows that Amazon Prime Day sales had been growing exponentially between 2015 and 2020. Amazon Prime members have many benefits, including free one-day delivery or Prime Video or Prime discounts. I believe Prime memberships give a huge economic moat to Amazon because it makes Amazon Prime members much more sticky. So they will buy products from Amazon first before buying products from Walmart or other online stores. Before investing in anything, we should also consider the risk. The first risk is the increasing US Treasury yield that impacts all US stocks, including Amazon. Recently, at the time of making this video, many tech stocks crashed as much as 10% or even more because the US Treasury yield suddenly increased much faster to above 1.6% than the market initially anticipated. Many investors are afraid the inflation rate will increase much faster and higher later on. If the US Treasury yield continues to increase much faster than expected, there will likely be more large sell-off of tech stocks this year. The second risk is competition. Amazon already has a dominant e-commerce market share in North America. The only company that has the resources to compete with Amazon is Walmart's online retail store. eBay tried to compete with Amazon but failed. It is very hard for most companies to compete with Amazon in e-commerce. Amazon already has the largest selection of products in North America and has the fastest delivery in most areas. Most consumers also think about Amazon first when they want to buy products online. However, in the cloud business, Amazon has two major competitors, including Microsoft Azure and Google Cloud. Now, Alibaba Cloud is slowly becoming the fourth largest competitor, but as far as I know, Alibaba Cloud mainly operates in Asia. I have been a long-term investor in Amazon for more than 3 years. I will continue to invest in Amazon for many years and continue buying more shares whenever there's a large correction. Because I like Amazon's dominant e-commerce and AWS businesses, and because I also like Amazon's long-term growth prospects. Based on my intrinsic value calculation, I believe Amazon stock should be worth around $4,470 per share or $2.28 trillion in market cap. Amazon stock is at $3,000 per share at the time of making this video. This means Amazon stock is likely undervalued. Again, all these are my estimates. You will need to do your own research to understand Amazon's long-term growth, understand the risk, and calculate Amazon's intrinsic value. If you like this video, smash the like button, subscribe, and turn on the notification button. I will continue to make many great stock investing analysis videos and personal finance videos that will help you become a great investor. This is Victor from the Intelligent Investor channel. Thank you for watching, and I will see you in my next video.